focused webinar this month. Today, many Indians celebrate Holi, the festival of colors. I wish everyone a happy Holi. Before I continue further, a few administrative matters. You may key in your questions through the Q&A tab, which will be seen only by the panelists. You can also send your questions through the normal chat box, which everybody can view. We will address your questions during the Q&A session. I have one request. Please do not wait for the presentation to end to post your questions. After the webinar, please do take a minute to complete the feedback survey. Your comments are always appreciated. Finally, as is the practice, this session is being recorded. The VAT go-live date of 16th April 2021 is just a little over 2 weeks away. Last week, the tax authorities posted on their portal the Arabic and the unofficial English translation of the executive regulations. While many non-Arabic speaking people are delighted to have an English version, please note that the Arabic version is the only legally binding version. The English translation is for reference. When in doubt, we must look at the Arabic version. Let's look at the agenda for this session, which we expect will take about an hour. After my introduction, we will provide you with a status update on Oman's VAT implementation. We will take you through the Oman VAT framework and then deal with specific issues for the financial services sector. These would include an understanding of which financial services are exempt and which are standard rated or zero rated. Does this cover only banks licensed by the Central Bank of Oman? How do you recover input VAT on non-exempt supplies? How is the apportionment to be done? What about the treatment of excess recovered by the insurance company from the insured? How will VAT apply on advance premiums on policies issued before the go-live date? What are the implications for the investment companies? Apart from understanding VAT issues, you also need to make sure that your IT systems understand the VAT requirements for the financial services sector. What changes do you need to incorporate in your ERP to not only deal with the day-to-day transactions, including raising VAT compliant invoices, but equally important to generate the reports that would be required for reporting to the tax authority? After the IT considerations, we will identify the next steps for you to be ready for the VAT go-live date. I'm pretty sure you will get there, as you did in Saudi Arabia, UAE, and Bahrain, despite many challenges. However, as you know, the go-live date is not the sole objective. You need to be confident that your VAT implementation stands scrutiny later by the tax authority, and you have strong advisors who can help you engage with the tax authority. You would also need to take into consideration new clarifications and guidelines which are bound to be issued as both businesses and the tax authority settle into the new VAT era. Continue to be engaged with the tax authority for our clients' benefit. In order to take you through all these topics, we have a distinguished panel of VAT specialists. ABA, our indirect tax partner in Oman, unfortunately has had to skip this webinar in view of an urgent meeting that has come up at the last minute. We have Dermot, a very experienced retired partner who is supporting us in Oman on the VAT implementation. We are indeed fortunate to have him. His vast experience across sectors and countries, including the UK, Australia, South Africa, and the UAE, will be of great help. We also have today Reese Penning, our head of financial services for tax. He also heads our indirect tax practice for the Lower Gulf. Lastly, we have Julie, who is not only a VAT specialist, but more importantly, a tax technology specialist. She has been helping some of the banks in Oman upgrade their ERP systems to deal with the Oman VAT legislation. I will now request Dermot to give the VAT status update and take us through the Oman VAT framework. Dermot.
Thanks, Ashok, and good morning, everybody. As Ashok said, we've got 17 days to the VAT implementation date of April 16th, and 122 days till you have to file your first VAT return. I'm going to make a bold assumption this morning and say that if you hadn't heard about VAT with only 17 days to go, you have a whole lot of pain ahead of you. So I'm going to assume that most of you have heard of and have some basic understanding of the tax. We give a very quick refresh on some of the principles, which will help you to understand some of the more technical discussion around financial services that Reese will lead us in this morning. However, there are so many issues in the financial services area that I want to be sure that we give as much time to that as possible. So my presentation is literally going to be a whistle stop. So as you can see from the slide, the decree law came out last year in October, and it states that the tax shall come into force 180 days after the decree law was enacted. That's where we get the date of the 16th of April. Many people have wondered why it falls in the middle of a month, but that's why the 180-day criteria brings us to the 16th. The first tranche of registrations should all now be in place. The cutoff was the 15th of March, although the tax authority are still accepting registration applications on the portal. The registration is mandatory for all businesses with a turnover of over 38,500 Omani Rial, but it is in a staggered implementation depending on the size of business, with the very large businesses turning over $1 million Rial having to register by that March cutoff. As Ashok mentioned, the tax authority have now published the unofficial English language translation of the regulations, which is good because I have no Arabic whatsoever, so I would be struggling if it was only the Arabic version I had to rely on. The regulations cover a range of topics. They're shown there on the screen, and we're going to cover some of those today as they relate to the financial services. But also, as Ashok mentioned, we anticipate that there will be further clarifications and guidance that need to come out between now and the filing of the first VAT return. For example, we don't yet have the format that the VAT return itself will take. So that will come later. Many of these notifications and processes may not come out until after the go live date. So it is an ongoing project, and this doesn't end on the 16th of April. Bit of the next slide, Judy, please. And the next one. So a very quick, what is VAT? It's value-added tax. It's a tax that's ultimately borne by the final consumer, which has particular resonance in the financial services sector because most exempt businesses step into the shoes of the final consumer and are actually bear the tax. It's charged at each stage in the supply chain on the value that is added in the supply chain. In some countries, it's referred to as GST. It exists in over 169 countries around the world. And in the Gulf states, as Ashok mentioned, Saudi Arabia and UAE introduced in 2018 and Bahrain in 2019. So Oman is the fourth country in the region to bring it in. Okay, the next slide, please. Some important principles that will help you understand the presentation in more detail are on the questions of a supply. In the VAT parlance, we don't refer to sales or revenues, we refer to supplies. That's simply because supplies encompass things other than sales or revenue, and it's important to use the wider definition. The time of supply and the place of supply are the when and where of the VAT world, and the value of supply is on what the tax is chargeable. The reverse charge is a specific mechanism which seeks to apply VAT to imported services where those services are imported in a B2B environment and where the supplier wouldn't or doesn't have an obligation to register in Oman. So without a reverse charge, no tax will be collected. The reverse charge mechanism makes the recipient of the service account for the tax as if he had supplied it to himself. And then he has to look at the second stage, which is, do I have an entitlement to claim an input tax credit on that amount? If, of course, the service is acquired directly for an exempt activity, then the input tax will not be recoverable. If it's incurred for both taxable and exempt, an apportionment will be needed. The term input tax is important, and there's a two-stage test. You have to first look and see, do you have an expense that is directly attributable to the making of a taxable supply, and if so, it's fully recoverable, or is it directly attributable to the making of an exempt supply, and therefore it is fully non-recoverable. It's only in the mixed category where supplies like overheads may relate to both parts of the business, and they need to be apportioned. So go ahead, Julie, with the next one, please. Very simple example, and this slide is just intended to illustrate the difference between zero rated and exempt, primarily. The difference, zero is a rate of tax, and even though the outcome is no tax on the final consumption, any business making zero rated supplies is entitled to recover its input tax, whereas businesses making exempt supplies are not. A general principle in the VAT world is that exemptions are exceptions to the standard rule, and therefore they have to be interpreted narrowly. So you have to fit exactly in the scope of the exemption for the service to be VAT exempt. And Reese will cover that in more detail later. Those are very simple examples, and I'm not going to work through them in the interest of time. I think everybody should know how VAT works in the various stages of the supply chain by now. If you go to the next one, please, Julie. So what are exemptions? The exemptions for financial services, which is obviously why we're all here this morning. There are other exemptions for bare land, and bare land is defined as land that has no structures either on it or under it. The resale of residential properties and the letting of residential properties are exempt, as is local passenger transport, healthcare, and education services. There are specifics for the zero rating, and I'm not going to go through those, but they do include medicines and medical equipment. A list has yet to be published by the tax authority on which specific medicines will be covered in that. There is a list of some 79 specific food items which are zero rated, and that clarification is already out there. And then you've got a zero rating for supplies that are made outside the GCC. Those are export of goods or export of services. And then the supply of goods and services which would be exempt in Oman, which are made outside the GCC. So you can have a financial service that would have been exempt had it been supplied to a customer in Oman, but where it's supplied to a customer outside the GCC region, it becomes a zero rated supply and opens the door to input tax recovery. And then there are certain categories of supplies which are specifically outside the scope of the tax, which are either supplies that are not made in Oman, or they're made between members of a same VAT group, and we'll cover that later. And then obviously there are various suspensions from a customs duty perspective, and the VAT treatment will follow the customs treatment. Again, probably not terribly relevant for financial services, so we won't go into much detail. The next slide, please, Julie. As I mentioned earlier, we use the term supply rather than sales or revenues, and one of the things that is a supply are specific deemed supplies within the VAT legislation. Now, an important principle here is that for something to be a deemed supply, the input tax related to it must have been deducted. So if the input tax was blocked or restricted, or you simply just didn't claim it, you can't have a deemed supply. The most common example of a deemed supply is a supply of goods or services without consideration. And again, there are specific rules around free gifts that may be given away as part of business promotion, and indeed trade samples, etc. Changing the use of goods from a taxable purpose to a non-taxable purpose is a deemed supply. So an example may be where you have a lease on a commercial building which you intend to use for a wholly taxable business of, say, leasing cars, and you then convert that to an exempt use for wholly used for banking or interest or other financial services activities that are exempt. That's a deemed supply, and the VAT has to be adjusted. Okay, we go to the next one. The others are pretty obvious, so we're not going to go into detail. The time of supply is an important concept from VAT because it dictates when is the tax due. And the basic general rule is that it is the earliest of, and I'll emphasize earliest of, the date of the supply is made, the date of issuance of a tax invoice, or the date of payment, whichever comes first. And then when you have continuous supplies, as you may well do in the world of financial services, it will be the date of payment that's specified on the invoice or the actual date of payment, whichever comes first. There are specific rules for imports and for vouchers, but in the interest of time, we'll keep moving to the next slide, please, Julie. The place of supply is the principle that dictates which jurisdiction collects the tax, and there are specific provisions in the legislation for both supplies of goods and supplies of services. It's interesting, in the VAT world, supplies of goods are clearly defined, and then anything that is not a supply of goods is deemed to be a supply of a service. So you need to watch that something that you may not have thought of as being a supply, such as a passive activity, can also be a supply of a service. And then there are some specific rules for various activities. The main one that might be of interest to this audience would be the services related to real estate, or where the real estate is actually located. Okay, if we move on, Julie, please. Input tax recovery, there are obviously the concept, as I mentioned earlier, is about recovering input tax on costs and overheads. The two red squares are the ones to focus on for this slide. It is that there are specific blockages within the legislation. Article 56 of the implementing of the executive regulations lists 3 activities, and they are entertainment expenses, motor vehicles that are made available for private use. Emphasis is on made available. They don't actually have to be used for private purposes. Just if they are made available for that, the input tax is blocked on the recovery of them. And then obviously there's a blockage on any goods that are specifically prohibited to be imported into Oman. You can't recover input tax in those circumstances. There is a scope for recovering VAT incurred prior to registration. You can go back up to 3 years prior to registration date in order to recover input tax that has been incurred. And that may be important where there are some specific areas of doubt within the legislation. You may determine that the best policy to be on the safe side is to not claim an input tax credit until greater clarity is provided by the tax authority, but you will have 3 years to go back. The reason for that cautious approach would be at least to avoid any potential exposure to penalties or additional tax for late payment because of claiming a credit that you weren't actually entitled to. So that's maybe an important provision. Okay, we go to the next one, please, Julie. Compliance, obviously, there are specific rules about retention of records. The general rule is 10 years, but in relation to real estate, it's 15 years. The returns at the commencement of the VAT regime are going to be quarterly, and there are fixed calendar quarters. The first return, as I said, will be for the quarter ended 30th of June, so it's slightly less than a quarter because of the 16 April start. and that return is due within 1 month of the quarter end. So the first return is due in 122 days from today, on the 30th of July. There is a provision in the legislation for refunds. So if you pay, if your input tax exceeds your output tax, you may apply to the tax authority to get a refund. And there are various schemes for diplomats and non-resident businesses, as well as tourists, to be able to claim back input tax incurred in Oman. You move to the next one, please. So that was a very quick, I hope, whistle-stop tour through the basic principles. I hope, Reese, I've left you enough time to cover the multitude of issues that are going to be for financial services. I'll hand it over to you. Thanks.
Dermot, and thank you, Ashok, for the introduction as well. Can we go to the slide, please, Julie? Thank you. So look, financial services can be really complex, or in fact, really quite straightforward. And I'd like to start with the straightforward part of it. All that questions can essentially be reduced to two fundamental queries. One is my output supply subject to VAT? That is, do I have a liability on what it is that I'm selling or providing to people? And as a consequence of that decision, am I entitled to claim input tax on the VAT that I have borne on my costs? All VAT reduces down to those two questions: liability for VAT on my output, entitlement to claim VAT on my input. Then we have the administration around documentation and returns and so forth. But all of our questions reduce down to that. Now, having an exemption or VAT exemption for financial services is very common. It's utterly consistent with international practice and indeed the GCC framework. So what that means is that, and certainly it's the approach adopted in UAE, Bahrain, and Saudi for obvious reasons under the GCC framework. So what that means is that, notwithstanding that VAT is clearly a newly introduced tax to Oman, but also to the region, to the GCC, we have got a very large body of international case law and precedent that we can kind of fall back on. Now, you know, a European Union VAT case obviously has no direct standing in Oman, but because VAT is a very well understood international concept, it gives us a really good starting point as to how the tax is likely to be interpreted in Oman. So we're not coming from a zero base of knowledge. We're part the way along the track, so we can use some of that learning both within region and internationally to make some informed decisions around how the tax authority in Oman will implement the law that we have. Quite important though, just to pick up on a point that Dermot made, having an exempt VAT supply does not mean that you are exempt from the tax. You can just ignore that and go about your business. It has a very specific meaning. So you're still in the tax system. You must still register in many circumstances. You must still file returns. You must still report your transactions. It just means that an exempt output supply, a supply that you make for income that you return or income that you receive, is not subject to VAT. And the consequence is that you cannot recover the VAT on your costs. So we've had some early discussions with people who are hoping that an exempt financial service meant that they were outside the scope of VAT. So just to clear that up, you are inside the scope of VAT. You still have compliance obligations. It just goes to whether you've got a liability and a corresponding input entitlement. So what I'm going to try to cover today is what is and what is not an exempt financial service. As a result, what does not give rise to a VAT liability and what will. And as a consequence of that decision, when, if, and to what extent you can recover input tax on your costs and what that might mean for your business. So if we go to, excuse me, to the law itself, we would reference Article 47, which simply says that financial services as documented in the executive regulations are exempt. Well, okay, so that means we were waiting for the detail to come through in the executive regulations as to what financial services would be exempt. We, of course, based on the GCC and other countries, we could make an educated guess. But now, of course, we have the finalised regulations. We go to Article 79, and it says that it defines which financial services will be exempt and in what circumstances. So that's, thank you, Julie. That's a very important point at which to pause. If you remember, I was saying that we essentially reduce the question down to, is my output supply exempt or taxable? For it to be exempt, you must fall within Article 79. So the fact that you're a financial institution that is doing something that meets the ordinary definition of a financial service, that's not enough. It has to be a financial service covered by Article 79 to be exempt. If it's not covered by Article 79, or as we see, it's explicitly excluded from being exempt, then it is standard rated taxable. So not everything that you do in the FS sector will be exempt. Only those limited things expressly covered by 79. So lesson then is you must check your agreements. You must check the terms and conditions of your products to determine whether those services and products and instruments fall within the confines of Article 79. If they don't, tax applies at 5% under standard rate. Maybe zero rate if it's an export, but the fundamental is it taxable or not, exempt or taxable, you must refer always back to Article 79 to see if your particular product and its particular terms and conditions allow or support an exemption. If not, standard rate. There is an interesting question for us VAT practitioners as to who is covered by Article 79. So, as drafted, Article 79 seems to be limited to banks and other financial institutions that are licensed by the central bank or another relevant authority, which we think would cover, for instance, the CMA. That is arguably a limitation in the sense that if I make what would be a financial supply, for instance, a loan, which we'll come to, but I am not regulated by either the central bank or licensed by the central bank or the CMA, then by different definition, it's not exempt and therefore would fall to be standard rated taxable. Now, that's a slightly different approach than is adopted certainly in the UAE and Saudi Arabia, and to most extent the European Union, where we look at just the nature of the supply. Is it the kind of financial service such as a loan that should be exempt? So here, though, we've got two steps. Firstly, am I a regulated financial institution as defined in 79? If so, we then look at the nature of the supply. So it's important to have a look at, well, who is going to be such a regulated institution? Now, clearly, banks with a trading license or banking license and insurance companies will clearly be covered. And we also think, subject to some discussions that Ashok has been having with government, that it will also extend to entities registered with the CMA. So there'll be a whole heap of things that are outside banking and insurance industry, which will be within the ambit of Article 79, but equally some that are not, and will therefore not be exempt and fall into the standard rated territory. So that's the who might be covered, but what are covered. And so I'll do it very quickly. We've seen, if you no doubt we've all read Article 79. So the financial services that are covered, loans and advances, as you would expect, credit guarantees, interestingly, hire purchase arrangements or lease arrangements where there is an ownership transfer, because interestingly, that is essentially just a finance lease. It's a provision of finance rather than provision of asset. Bank deposits, whether that be current savings or deposit. The supply, transfer or issue of financial instruments such as derivatives and forwards. The supply, transfer and issue of debt and equity securities. For instance, debt securities such as a bond, an equity security like a share. So dealings in debt and equity will be exempt. Life insurance is exempt, but importantly, not non-life insurance. So anything other than life insurance will be standard rated. General insurance, house and contents and so forth standard rated. And then finally, excuse me, there is a provision, an equivalency provision, which says that, so Article 79 talks about, if I may call them, the sort of traditional or Western products. Then there is an equivalency provision that says that an Islamic finance or a Sharia compliant product or finance should receive the same VAT treatment as the other sort of more conventional, if I can call it that, product. So for instance, it tells me, Article 79 tells me that life insurance is exempt. As a result, takaful life insurance should also be exempt as a Sharia product. Equivalently, murabaha leasing arrangement is fundamentally a leasing arrangement over an asset. It should be taxable because it would not be VAT exempt as a non-Sharia compliant leasing arrangement. So we're looking for equivalence there, basically to not distort the market as between traditional and Sharia compliant financing. So that's all interesting and very standard in terms of list of the exemptions that, loans, credit, securities, equities, exempt. Very standard, very much expected, meaning we can fall back on our learnings from other jurisdictions to help here. What is really important, though, that it's not a blanket exemption, because Article 79 goes on to say that each of those things is exempt unless it is remunerated by way of, or the payment of the consideration is by way of a fee, commission, or a commercial discount. So if you have a fee, an express fee, or commission for what would otherwise be an exempt financial supply, it stops being exempt and starts being standard rated. So coming back to my initial comment then, what's really important is that you look at your terms and conditions, because just because you're a central bank regulated institution, for instance, and you make something that is a financial service, there's one more step. How are you remunerated? You need to look at the fees that you're receiving. And so if you get all the way through and you say, oh, I get an explicit fee for that service, you fall out of exempt and it becomes standard rated. So you have to trace it all the way through, down to the terms and conditions, looking at the fees. Dermot mentioned zero rating for supplies to counterparties who are outside the GCC. So for instance, if you were making a supply to someone in Egypt, a loan, for instance, to someone in Egypt, that would be zero rated. The consequence of that would still be no output VAT, but as Dermot mentioned, that would allow you to access input VAT on your costs. There's also some zero rating for supplies into the special zones and the special economic zones. However, and have a look at Article 107 of the regulations. There are some really specific requirements for you to establish zero rating treatment and to validate it. So just because your counterparty is in a special zone, it doesn't automatically give you zero rating. You need to go a few more steps, which we'll come to in terms of collecting information. So that's a general overview. Dealings with debt, equity, life insurance exempt, unless we've got a specific fee. So what I thought I might do is preempt maybe some of the questions that we expect to come through the chat box by looking at some specific examples of where I think, or where we think that we will fall either side of the exempt or standard rated line. So we'll start with the easy ones and they'll get progressively more difficult, or at least more challenging. And quite often with FS, the answer depends on the facts of your particular circumstance, exactly what your contract says, what your terms and conditions are, what your fee structures are, or your remuneration structure. So I'll give some general comments, but one must always go back to the terms of your particular arrangement to confirm them. So let's do the easy ones first. Services related to financial services are taxable. So for instance, brokerage on the trading of securities, or an agency fee for entering into a life insurance arrangement. The underlying transaction, the equity transaction or the life insurance, that's exempt, but the services related to it are taxable. So that would mean that the broker charges a VAT amount to the share trader or the life insurance company, and then it's a question of whether they can recover input tax back. So there is no, in the EU and other countries, there's often, they extend the exemption to intermediary services, as they're often called. That is not the case in Oman. So those related services are clearly taxable. So if you're in that industry, tax it. Interest would be exempt because that is a margin-based or a non-explicit fee-based remuneration for an exempt or a financial service of a loan. Dividends themselves would be out of scope, meaning that they do not give rise to a VAT liability. They're essentially disregarded for VAT because they are the return on a share, not the remuneration for a transaction or supply with the share. So then we get, so those two are pretty straightforward, we think. We get now to the slightly more nuanced, what about bank fees? So if I wish to borrow some money from a bank in Oman, we would say, well, we've got a central bank regulated financial institution. It's making a loan, which we know is a financial service, should be exempt. But, so then we get, well, the underlying loan itself with the interest, that should be exempt because that's a margin-based remuneration. But what if, as is always the case, I have to pay a facility fee and a commitment fee and some other fees? We think the better view is that those explicit fees give rise to a VAT liability, whereas the underlying interest does not. And that's because of the exclusion for exemption for explicit fees. Now, there is an argument to say, well, surely it's just a single overall supply of a loan, and the primary part of that is principal and interest, so it should all be exempt and we can disregard the fee element. I think the better view, and certainly the more prudent view, and if I may, the perhaps internationally accepted view, is that the interest component does not give rise to VAT because it's exempt, whereas the explicit fee component, the commitment fee, for instance, that is subject to VAT. Again, that's something you're really going to have to dig down into the terms and conditions of your loans and how you're remunerated. Penalties is a fantastic discussion that we could spend an hour or so on. To keep it very, very simple, for VAT to be payable, we need a supply for consideration. The generally accepted view is that most penalties are in the nature of compensation and there is no underlying supply. However, that won't always be the case because some payments are called penalties, but they're in fact a fee for a service. So for instance, a late payment penalty could in fact be additional remuneration for extending credit. Then one looks at, well, is that an explicit fee for credit taxable or an implicit fee and therefore exempt? Again, you need to go to the terms of your contract. There's no blanket rule here. Agency arrangements are an interesting one in the sense that, for instance, many banks and other institutions will be a distribution channel for an insurance company. And so what really comes there is, are you acting as an agent for the insurance company, in which case the insurer is providing the insurance to the policyholder, and you are providing facilitation and distribution services to the insurance company, which would be taxable because it in and of itself is not an exempt financial service. Equally, are you a reseller? In which case then you are providing that service. So it's very important to look at your arrangements, and no doubt you've been doing these for years, so you have a very clear view internally as to whether you're an agent or a reseller. Critical from that, if it's an agent, one will just flow through and essentially disregard the underlying transaction. If you're a reseller, you need to recognize the buy and the sell. Speaking of insurance, and that of course could be a seminar all of its own, there's a host of very interesting insurance questions that are raised. And again, I'll try to deal with some of them in anticipation of the questions that we expect to get. The first one is, what do I do on transition? As Dermot said, 16th of April is only 2 weeks or so away, and the first return for the period ended 30 June is due in 122 days in the end of July. What do you do with the portion of unearned income or unearned premium that you still have on hand? So if I paid a year, 12 months worth of premium on the 1st of January, to keep it simple, of this year. Some of that has expired and relates to the pre-VAT period, and some of that has not expired and relates to the VAT. Our view is that under the transition rules is that VAT is payable on the balance from 16 April through to the end of that period, end of that the premium period that covers, in my example, through to the end of the year, and that VAT should be reported in the first tax period, which would be the tax period 16 April to 30 June, with a return due in July. Now, of course, that's the case for non-life insurance. If it's a general home and contents or asset insurance, we think that is payable on the balance in that first return. If it's exempt, of course, as we've discussed, that life insurance is exempt, so one would report the premium, but of course it doesn't give rise to a VAT liability in that first period. There's always an interesting question about whether reinsurance is taxable or whether it follows the underlying treatment. Our view is that reinsurance will follow the treatment of the insurance policy that is being reinsured. So therefore, domestic reinsurance of a life policy, we believe, will be exempt, whereas reinsurance of anything other than life insurance should be taxable. That's on the basis that if one thinks about it commercially, reinsurance is in fact insurance for the insurance company with respect to the insured event, which is cessation of life in the context of life insurance. As a result, we believe it is covered through the definition, through the legal definition of the insurance provisions under Omani law, and as a result should be exempt. When one gets to making or paying out a claim made by an insured or by a policyholder, as a general statement, making a cash payment to a policyholder in the effect of a claim should give rise to no VAT liability on the basis there is no supply coming back from the policyholder to the insurance company. Equally, any payment of an excess or deductible by the policyholder, again, should not give rise to any VAT liability for either the policyholder or indeed the insurance company. What is interesting though, or may be interesting, is whether the insurance company or the policyholder is entitled to any input tax on services rendered in settlement of the claim. So for instance, if an asset is damaged and repair services are obtained to get it back up to its normal standard, and those repairs are funded by the insurance company, there'll clearly be VAT by the repair company. It'll charge some VAT. Who gets the input is a great question, and fundamentally it comes down to, well, who has contracted with that insurance, the repair company, and who has acquired the repair services. If it's the insurance company has contracted and acquired, then as Dermot says, well, that's making the acquisition is one of the prerequisites for claiming input. So again, you're going to have to look at very closely at your contract and your contractual relationships with the insurance company, because with the repair companies and so forth, because if they have a relationship direct with the policyholder and the insurance company is merely funding it, then it's made no acquisition and is not entitled to any input tax recovery. So you need to have a very good close look at that. Sliding on, there's also an interesting question around whether insurance for international transport is covered under the specific zero rating rules, Article 90 in particular in the executive regulations. That's a vexed question. We think the prudent approach at the moment is that no, it is probably not zero rated. One could argue on a policy basis that it should be zero rated, but certainly on the way the provisions are written at the moment, it looks to be a pretty narrow zero rating that we think probably does not, on current drafting, extend to international transport. But that's an interpretation of the provision that we'll need to test with the tax authority in time. Julie, would you go to the next slide for me, please? Thank you. So Dermot touched on it, and it's really important. It's the other side of the coin of exemption. So exemption is good news for you because you don't have any VAT liability on your output, but it's bad news for you because you cannot recover the VAT on your related inputs. So you'll find that set out in Article 42 of the law and 54 of the regulations. And you do that test. So the question, am I entitled to an input tax recovery or a credit, needs to be looked at for each acquisition. It's not a general blanket position for your business. We look at the thing that you acquired. Do I get an input tax recovery for that particular acquisition? And the test is broadly, do you use it to make a taxable supply? The answer is yes, you can claim. If the answer is no, you cannot. Then you go on to the next acquisition. Do I use it to make a taxable supply? Yes or no? So that's all pretty straightforward in that sense. So you go to Article 58 of the regulations, and it sets out a process for you. And it says, well, first of all, have a look at the things that you acquired. Some of them you'll be able to say are only used wholly to make taxable supplies, and you claim those in full. We call that direct attribution. Second step is, well, there'll be some direct attribution of things that are only used to make exempt supplies and not taxable supplies to any extent at all, directly attributable to exempt, so you can't claim any of that. What's left is often called residual or overhead expenses. Those are things that are used, general expenses that are used to make both exempt and taxable supplies, and you need to apportion them so you can claim input tax to the extent that you use them to make taxable supplies. An obvious example, if you were a bank, it might be, for instance, rent that you would pay on your branch building. Within that building, you're going to make both taxable and exempt, so the rent relates to both taxable and exempt and needs to be apportioned. Now, Article 58, excuse me, sets out a default method for doing that apportionment. You'll see it there in the bottom left-hand corner of the slide. It's what we call an outputs-based method, and it says, well, claim as a proportion of these costs the value of your taxable supplies over the total of all of your supplies, taxable and exempt. So, for instance, if you make 20 reals of taxable and 80 of exempt, then that formula would be 20 over 20 plus 80, 20%. So that formula would tell me that example that I can claim, coming back, 100% of all my costs that relate to only taxable, 0% of all my costs that relate only to exempt, and 20% of all the remaining costs that relate to both. There's an annual adjustment provision that says, well, at the end of each year, you look, so obviously that's done on a quarter-by-quarter basis, that default calculation. Annual adjustment, look at the annualized figures and you know, see whether you have an increase or a decrease, and either pay more to or receive a reduction from the tax authority. Now, so that's the default method. You can apply to use an alternative method, and that needs to be approved by the authority. Fundamentally, you're only going to to apply for that, you need to establish that, for instance, the default method does not give a fair and reasonable result because it does not reflect the basis or the manner in which you use those particular supplies. And that is often the case because if you think about a particular transaction, the revenue formula or the outputs-based default method essentially says, well, the amount of effort that goes into a supply is shown by the amount of revenue that it earns. So if I'm trying to use apportion my IT costs, I look at the revenue that it uses, revenue it generates. But of course, that doesn't always follow. Some things are used more heavily for a particular transaction than others. So you might be able to argue that a transaction count method or some other inputs-based method would apply. But you need to apply for that, and you need to justify to the tax authority why that is not the case. Just with one eye on the clock, I think I might just leave it there, other than to just touch on some IT issues for Julie. We can think about tax invoices. Do we issue them? The ERP system for financial supplies is essential. So Julie, with that, I might hand to you to talk about some IT issues and other systems considerations.
Thank you, Reese. Indeed, looking at the time, because we did receive quite a lot of questions from you, so we will want to address those as well. So one couple of things that I want to mention in terms of IT. So this slide looks very complicated probably, but these are basically all of the VAT touch points that you will find in your IT landscape. And what is essential for financial services sector is that because of the complexity of exemption and taxable fees, and the fact that probably in Middle East the transition to taxing all of the fees has gone. It wasn't even transition. That's how the legislation was set out. Whereas if you're a multinational bank that is operating in Europe, you will find that there is much less taxable revenue that you would have in Europe as compared to Middle East. So your banking systems are typically not very well equipped to deal with taxation as such, because a lot of them are quite old, and what we see also in the industry is that you use a lot of different systems for different types of your businesses, and that makes dealing with VAT actually quite complicated. So what is essential is that you look at what is it there in your systems, where do you have fees, because these will be essential to be addressed as taxable. How do you make sure that you identify your exempt transactions, because it is only the margin that you need to see as an exempt turnover. It's not, say, your whole loan amount, but it's only the interest that you earn. The difference of Oman legislation is that it does not explicitly exclude exempt turnover from necessity to issue a tax invoice. So where you are already operating in other GCC countries, you might not be issuing an invoice for exempt turnover. That will be different in Oman. At least this is our current view, because the Oman legislation refers to supplies when talking about when do you need to issue a tax invoice, and exempt supply is still a supply. Hence, in our view, a requirement to still having a tax invoice. So where in UAE you would be maybe only issuing an invoice for those fees that you're charging, in Oman it will be all of your transactions. So other things maybe to just quickly mention, everything in your system is basically starts with the basis of your master data. So I mentioned about differentiating between exempt and taxable supplies, but also your customer and supplier master data is very important, because that will help you drive whether you apply zero rate. For example, if your customer is outside Oman, on the supplier side, that will drive whether you need to apply reverse charge or not. So make sure that you also look into your customer and supplier master data to make sure that it's up to date. And one final note that I want to make in terms of complexity that your businesses will have in terms of recovery. Make sure that you have enough tax codes set up in your system to distinguish between different types of expenses that you will be incurring, to directly attribute them to either taxable supplies, exempt supplies, or what we call residual expenses. Because identifying that allocation at the moment the costs enter your system will help you tremendously at the reporting point of time, because what essentially you want to have is at the AP entry, that's when you can allocate the cost into those 3 different buckets, so that at the reporting you only need to apply the percentage of your recovery ratio to that residual cost bucket. If you do not have that separation of different tax codes, all of your expenses will end up on, say, 1 or 2 tax codes, reverse charge and local taxable with 5%. And at the return preparation process, that's when you will need to do all of the allocations. And that will just be a very complex exercise to do at that point of time, because it sounds like you have a month to prepare your VAT return, but believe me, it will be very quick, because first your systems will be closed for the month closing, so you will only be able to do your reporting after, say, 5th of the month. And then if you at that point of time need to do all of your cost allocations, you will just very quickly run out of time. So these are just the very, very basics that will help you get through your initial setup. But another point, and I think other speakers have already mentioned, there will be changes. So make sure that your system is not completely set in stone, because there will be clarifications. There will be we are expecting that there will be a financial services industry guide. So be prepared for change, and make sure that your systems are agile enough to deal with those changes. So with that, I give it back to Dermot.
Thanks, Judy. And again, conscious that we've actually run out of time. The core message from this slide is simply, please do not take that VAT is a finance project and only affects finance within the organization. I think, as we've demonstrated throughout the discussions today, it has a wide application and it impacts almost every part of the business, and therefore every part of the business needs to be involved in the VAT implementation project. If you move to the next one, the mission critical items, 17 days to go. What can you achieve in 17 days? We would take it that actually you should be looking at this as all the way up to the first return. So you've got 122 days. Prioritize what you can do, but unless your accounting system or ERP system is already configured and has been tested, etc., and you have your cutover strategy already there, there's probably not a lot you can do. You can heighten the awareness for your staff of VAT issues, excuse me, because remember, your staff are going to be your frontline interface with both your vendors and with your customers. And they need to have some knowledge, because you're likely to get questions from both as to VAT and how it's treated. Remember, VAT is new to everybody in Oman. And therefore customers may not have an understanding of why VAT has been added to something and where it hasn't been added to something else. So it's going to be important that your front of house staff have a general understanding of VAT, and that'll get you ready for 16th of April. Okay, we've run out of time. I think, Ashok, you're going to coordinate the Q&A session. We've time for some, if people will stay on.
Yes, thank you, Dermot, Rees, and Julie, for that insightful presentation on the financial services considerations. There are, as expected, a number of questions. Let me straight away go into them. The first question, if I could ask Rees to address, I think he briefly touched this during his presentation, but the question is very specific. We are a financial services organization operating in Oman with our headquarters in GCC. We are not licensed by the Central Bank of Oman, but by the Central Bank of another country in the GCC. will we be covered under the exempt category? If not, will we still get the VAT exemption on margin-based and interest income?
That's a very difficult question. And Ashok, I'm just going to look to you here for a nod as I say. My understanding is that sort of your discussions with government is that it is intended that exemption is limited to organisations that are registered with or licensed by those central authorities. So if the question is company or entity is not so registered or licensed, I think it falls outside the exemption.
Yeah, and this is something which came up because some of you all may be aware that the tax authority had shared with certain people, including us, the draft of the executive regulations, and we did point this out to them that this sort of restriction on qualifying as a financial institution only if you're regulated in Oman may not work. But interestingly, they have not removed that anomaly, if I may say so, in the final executive regulations. So the question remains: how do you treat banks which are not licensed by the Central Bank of Oman? And what do you think, Reese? I guess eventually they will have to clarify. Otherwise, how will no country in the world taxes margin-based? Yeah.
Very few. I think there are two answers to the question, as you say, Ashok, is that firstly, on its terms, at the moment, if you fall outside the regulation, then you fall outside the exemption. My personal view is that in time, it will be clarified to apply to others as well. But at the moment, it does not.
Correct. And I think the answer to the next question also will be the same, I guess. The person is asking, saying that we are a non-banking company selling under lease to own with 3 years term. Would we be covered by the exemption?
Yeah, I think it's the same thing. So I think the product is, it's a question of whether the institution is covered by the exemption.
Correct. Okay, if I could ask Julie to address this, I think she covered it during her IT presentation. Please confirm if a taxable invoice is required to be issued for exempt supplies.
Yes, indeed. I mentioned it in my short speech. Our current interpretation is that also exempt supplies need to be covered by a tax invoice. Just by the way the regulations are written, that they're referring to supplies rather than taxable supplies. So unless that is clarified, we suggest that you issue tax invoices for everything.
Dermot, this question again from a bank. Would waiver of fees qualify as deemed supplies? Waiver could be voluntary. Example, bank may decide to waive a fee, or mandatory, for example, waivers mandated by central bank.
Well, I think if you make a voluntary waiver of something, but you still supply it, then you fall into the definition of a deemed supply. You've given something away for no consideration. It's always a tricky one when you come to services, obviously. Were you entitled to it, or did you just not collect it? The safer strategy would be to offer it by way of a discount to show that you didn't recover. You did and were entitled to charge, but you chose not to by way of a discount given to the customer. Mandatory waiver would be slightly different, I guess. If the regulator is saying you cannot charge for that activity, then the question is, was it a supply at all? Because you did something that was arguably illegal and therefore not technically a supply. So again, it will come down to the circumstances of each individual transaction, and I need to look at your terms and conditions as to the circumstances in which the waiver was applied.
Sure. Let me move to a few insurance-related questions. Reese, if I could ask you the first question. and I'm not sure whether you covered this, but let me repeat the question. Whether the excess recovered by the insurance company from the insured would be taxable or would it be outside the scope?
Thanks. Yeah, so we consider outside the scope for the excess or the deductible recovered, outside scope.
Okay. Julie, in Oman, there is also when insurance companies issue an invoice for premiums, they also have to add the CMA fee, the Capital Market Authority fee, and emergency fees. So the question is, would the taxable value include the CMA fee and the emergency fees?
So in principle, all the fees that are, you need to distinguish between whether the fees are chargeable to the insurance company or is it a pass-through that is actually deemed to be paid by the insured. So depending on whether if the fee is charged to the insurer, then that fee becomes part of your consideration. If it is a fee that you're collecting from the insured on behalf of a different authority, then it can remain outside of your consideration.
Okay. Next question, Rob. Sorry, Dermot. What is the treatment for medical insurance for employees and their dependents from a input tax claim perspective?
Yeah, this one has come up before. If the medical insurance or provision of medical insurance is a condition of the contract of employment for the employee, we would say that the input tax would be claimable on the premium. However, their families may be different, and the tax authority may take the view that that is in fact a deemed supply. Or block the input tax recovery, depending on which side of the insurance you are. So I think you need to look at it carefully. We don't have clarity at this point. The safest bet would be not to claim it to the extent that it relates to dependents. And when the clarity comes out, you have up to 3 years to go back and make an adjustment if it subsequently emerges that it is in fact deductible.
Yeah, sensible advice. Reese, last couple of questions to you. This is related to marine and aviation insurance, related to the international transport. Would this be rated or standard rated?
I addressed this briefly because it was a difficult question and I didn't really want to answer it in the presentation. Look, so the provision is it's Article 90 and it says that a service that relates to international transport is zero rated. So the question is, does insurance of the passage relate to the transport or is it sufficiently closely related? If you have a look at the rest of the provision, the inclusive examples that it uses are very much related to physical dealing with the goods or the vessel itself. Whereas obviously insurance over the goods, the cargo or the vessel is an intangible. We think the prudent approach at the moment, subject to getting then clarification out of tax authority, is to treat as taxable or standard. But I think there are decent arguments for zero, but prudently we're advising to treat as standard for the moment, if commercially you can, and then we can get some clarification, just because of the way the provision is quite narrowly drafted.
Yeah, I think we would need to seek clarification from the tax authority on matters like this. Hopefully
Yes.
they will set out their position in the coming weeks. So let's hope that happens.
And ultimately,
last
it's an
question.
interpretation question. Yes, go.
Yeah, last question, and this is relating to investment companies. A number of the attendees are representing investment companies who are neither insurance nor banks. What would you think are the issues investment companies should be considering, particularly in relation to the financial services sector?
Sure. I mean, it's a great question, and take as given that they are licensed by the relevant authorities and therefore within the scope of Article 79. Because of course, if they're not, then everything is taxable. But if they are, then I mean, ultimately, they're going to be providing investment-related services, advisory and so forth. those are going to be taxable. They're going to be buying and selling equities, both security and debt, equity and debt securities. Those will fundamentally be exempt. They're going to be having dealings in derivatives, forwards, swaps, all those kind of things. Those are going to be exempt. They will need to, therefore, as a consequence, think about what that means for their input recovery position. Because, of course, they'll be making both taxable and exempt provisions, and whether the default apportionment method is appropriate for them or whether we apply for a specific alternative method. And I think maybe, interestingly, what could be very interesting for them is the extent to which they're doing things in a cross-border or a transnational way, and whether the zero rating would assess them. So, for instance, making an investment into a foreign asset, for instance, whether that allows them to access zero rating for what might otherwise be exempt and therefore recover costs.
Right. Thank you, Reese. That's very useful. You have addressed, you and the other team members have addressed a number of questions of the participants. I would like to thank all the attendees for their active participation. I'm sure you will continue to have a number of questions which require a resolution. We at KPMG are available to assist you. And in the meanwhile, good luck with the VAT implementation. Thank you.